Jake, high level, why should anybody want to hear about this deal?
You got it. Yeah, so this is a new build, purpose-built 6-unit. So right off the bat, that should be one reason why somebody would be interested in this, because you're buying brand new product. It's not every day that people are building new sixplexes because of the cost of building and the cost to acquire land. Usually you have to go higher, more density, et cetera, et cetera.
Yeah, you got to do a lot of units.
It's very rare where you find something brand new like this. The other reason is because it's brand new, number one, you don't have rent control.
That's
right. So on new product after October of 18, there's no rent control on these.
Welcome back to REI Hot Seat. Andrew Hines here with Jacob Campagnaro. It's the old crew.
All right.
The original cast of the show. So Jake and I are going to be reviewing a deal, Sixplex.
Yep.
Welland.
Yep.
And
off market.
Off market. So the numbers appear to work from what I've seen. So this has been modeled out, and I'm looking at a cash flow right now. Jake, high level, why should anybody want to hear about this deal?
You got it. Yeah. So this is actually a really interesting deal. I came across a couple days ago. I went and saw the property. So I've been on site. I've toured, and this is a new build, purpose-built 6-unit. So right off the bat, that should be one reason why somebody would be interested in this, because you're buying brand new product. It's not every day that people are building new sixplexes because of the cost of building and the cost to acquire land. Usually you have to go higher, more density, et cetera, et cetera.
Yeah, you got to do a lot of units.
It's very rare where you find something brand new like this. The other reason is because it's brand new, number one, you don't have rent control. Right. So on new product after October of 18, there's no rent control on these. So you can now increase your rents on these units annually to whatever you feel is market rent.
Until they pull another thing like Kathleen Wynne did in, like, what was it? Like, what year did she do that? It was like 15 or 14. She did that. And then Doug Ford said, well, we're going to do a new date in 2018.
Which has been held strong, knock on wood.
So,
right?
So far,
we're holding strong. And I think it's needed still. Like, I don't see that coming, them clawing that back.
It puts a little bit of power back in the landlord's pocket. Now, and the reason obviously to do it is to encourage people to build new. And there's so many incentives now for purpose built, not to get tangent here, but there's so many incentives. Like, I know multiple investors that their whole strategy is they're just going to go in and build ground up. Yeah. They're going to go ground up and build purpose built rentals, which we're going to see a lot more of that, I think.
And that's why I'm confident in this no rent control thing. I don't think they're going to claw it back right now.
Because it builds distrust, right? If they do it again, I mean, they're already doing so many things to build distrust, but
anyways, so that's one thing, is the no cap gain. So amazing, right? Because usually you're only finding that on condo units because those are new, or like,
you're saying no 30, rent restriction.
30, 40 unit large multifam. So it's exciting for a sixplex to have that. The other thing is that because it's new, we have separately metered utilities completely. Water, gas, hydro.
No common meter for anything?
No common meter.
So how does it work? Is it a walk up? Or
it's a walk up. So it's basically, it's almost a stacked town if you look at it that way, where you have unit 1, unit 2, unit 1, unit 2. So no common area, and the exterior lighting is actually attached to the garages,
so which
is billed back to the tenant.
So there's no utilities.
There's zero utilities to the landlord.
That's great.
It's cool. Yeah. So that's the other thing, right? So those two alone should be enough to gauge interest. But then the numbers work. Like we ran through it. The rental stats, we've really dived into the rental stats because again, it's a smaller market, but we are confident in those rental figures. We have clients that own new build in the area, and they are getting similar figures. So the rental figures look good. CapEx is going to be little to none on new builds for at least a good,
for sure,
let's call it 3 years.
But you're still underwriting it with the CMHC guidelines anyway, right?
Yeah, always.
So there's no roof to do, there's no boiler, there shouldn't be like anything like that. For what? Like, when would you expect to replace on these? There is no boiler, so you've got heat pumps probably in the units.
They're all mini split heat pumps, high quality.
So no gas in the building?
There's no gas.
Yeah, so I mean, those should probably, I don't know how long they're set to last.
Yeah,
but
I would 5 years.
I feel like more. You think they'll only last 5?
Well, maintenance. You need to do maintenance on those.
Yeah.
Right.
What kind of things? Like you're going to end up replacing a burnt out part. I mean, my approach with that kind of thing is just use it until it breaks. I mean, obviously I change furnace filters and such, clean filters.
But with those mini splits, you should be cleaning the actual condenser, the filter, right? There's little maintenance items, but again, that's not CapEx.
Yeah, that's just in your maintenance.
That's ongoing maintenance.
Yeah.
So CapEx, I would say, start accounting for things, I guess, at the 5-year mark. Right?
Yeah, like you could have one of those units burn out, of course. Like if you've got 6, like you're gonna have probably a problem.
But the way I look at it is, what's the warranty on most of these items?
5 years.
Right, 5 years.
Yeah.
So at the 5-year mark, you should be there with some cash in your pocket to say, okay, if something's gonna go wrong, I have the money to fix it.
You've been budgeting, right? The 2% replacement reserve, right?
Exactly. But what's nice is, yes, we underwrite it that way for CMHC. But if you're really not putting any CapEx into it, that money is going to be in your account.
Yeah,
right. That's
time,
cash flow.
It is.
In essence,
so those reserves and stuff, and some people may go as far as to set up a separate bank account under their corporation that holds it.
That's what I do.
Just for your CapEx. That's where you sit that money. Hopefully, it pays you the 2% interest a year.
Makes it less easy to spend when it's sitting in a different account.
Yeah, exactly.
Yeah, so less CapEx. Obviously, the layout of this building is again the walk-up style, almost like stacked towns. So you're getting larger, more tenant-friendly units, right? And so it's a 3-bedroom, 2-floor unit, right?
Wow, yeah.
So you're getting living room, kitchen space, dining room space on the main. Then you go up a set of stairs and you have a 3-bedroom with a bath and then a half bath on the main, right? So it's like it's
almost like a townhouse.
It's like a townhouse pretty much, right?
Well, stacked townhouses, you have one unit on top of another. Is that the case?
Yeah. And then the 1-bedrooms are on the main floor here.
Oh, that's right. That's right. Okay.
So really nice little layout. And then on top of all of that, what I really liked about this building is I showed up an hour early to my showing. I drove around the neighborhood. I checked out what's going on. And there's actually a brand new subdivision that just went up. Mm-hmm. There's another subdivision that's going up currently. And then right behind this build, it's a park, call it a park, big piece of land that they're developing right now. They're just starting to break ground.
Yeah.
So you are literally surrounded by all new subdivision within that market. Which is pretty exciting. So we're going to see a lot of gentrification come.
Yeah.
You're getting in at the good time, right? And
expecting that neighborhood to sort of mature.
And that neighborhood will mature, and those projects are all sold out already, all those res projects.
Interesting.
Which is cool, because they sold out a few years back.
Yeah, I was about to say if they were trying to sell now, it probably wouldn't work as well.
No.
Okay, so just high level looking at the rent roll here, I've got numbers in at, these are current rents? So 2,500, 2,500?
Those are projected rents.
Okay, so is it vacant right now?
It's not even completed. It's framed, roof is on, windows are in, but that's it.
Oh, okay. That's an important detail. Okay, so this is going to be done. So this is basically proposed as a straight to CMHC. Will it meet? I guess you don't need to meet any of the special incentives with MLI. You're not doing that.
They do have an efficiency report done for the HVACs and windows and insulation. So it is above building code. Mm-hmm. Whether you want to go down that road or not, where I think you're going to get caught up on this deal is because you can get 50 points MLI with just efficiency.
Just efficiency now,
right?
Yeah.
And with 6 units, it's not enough to go affordability.
Yeah.
It doesn't make sense to hurt yourself that way. So I would, if you're going to do MLI, you're going to go MLI, you're going to do the 50 points. And it more than likely can hit it just based off of the above build code.
And what would that get you over the standard?
So it's going to get you the 1-1 debt service.
Okay, so lower requirement. So for anybody who does not understand this program, I'm just going to break it down real quick.
Go for it.
MLI Select is a program within CMHC. CMHC is an insurer that protects the lender. If the lender is protected, they're more willing to give you good terms. So people want to get CMHC insured mortgages with these multifamilies because it allows them to get higher loan to values. It allows them to get longer amortizations and lower interest rates. So the MLI Select program is a higher tier within CMHC's offering, and that one requires that you hit these efficiencies. So you either build it energy efficient, or you build it accessible for handicap, or you build it accessible for rent. Yeah. So lower affordable. Yeah. So there's a couple things you can do. You used to be able to hit 100 points and get the best of the best, the 50-year AM, the super low interest rate, which you get either way. So 50-year AM is the big difference. And then the lower debt service requirement, meaning that you can borrow more against the rent you're bringing in. Mm-hmm. Because the 1.1 debt service ratio means that your operating income can cover your debt service 1.1 times. 1.2 means you have to cover it more than one. Now you're covering it 1.2 times. That's obviously going to be harder to do, which is going to pull back your loan to value.
Yeah.
So people want this because you got investors going at 95% loan to value. So just a refresher on that, because we haven't really fully explained that in a while, and new watchers of the show, new listeners are probably going to.
And I will mention something, because this has come up several times in the last conversations I've had. Just because you're doing CMHC, MLI, or not MLI, whatever it may be, doesn't mean you have to take the max loan to value.
Yeah, you don't.
Because I've actually had this where people are like, "Oh, well, I don't want to do CMHC because I don't want 95% loan to value."
Yeah.
Right? Like I've had that conversation.
Well, you still do it because you have lower fees, right?
Well, if you hit MLI, you save massive on the fees. So your insurance premium,
their insurance
your fees,
premium is like over 4%. It's like between 4 and 5.
And this,
so it brings it down how much? Do you know?
I can find the numbers. We'll put them in the show notes.
But it's meaningful. It's like percentage points lower.
Oh, big time. Yeah, we have a calculator that shows it. And I recently looked at a building, and with traditional CMHC, it was going to be 80,000, and then MLI level 3 CMHC, I think we got it down to like 20,000 in fees.
Yeah, on this I don't see the premium calculated, so there's a little give and take. We'd have to sub the premium in there.
Yeah.
There is a formula to calculate it, and it says no. So I'm guessing we just need to tweak something on the sheet here to show the number.
We'll take a look at that.
But yeah, so there is going to be a premium in there, so a slight adjustment to these numbers in terms of the amount of money down.
Yeah.
But well, they actually add that to the mortgage.
They do add that to the mortgage.
Yeah. Okay. So it's not an amount of money down. It's just going to slightly affect the
cash
payments.
Flow. Your payments go up. Yeah.
Yeah.
Anyhow, so sorry, where I was going with it is, I've just had that conversation. I wanted to note that because you can get the better rate. You can get the lower fees, and you can pick your loan to value. You don't need to max it out.
Yeah. Pick your loan to value. You don't need to go the full 50. I'm kind of like personally opposed to a 50-year AM. Like I want to pay off a little more aggressively. I want to find a way to make a mortgage work, 40, 45, somewhere in there. But some people don't care at all, and 50 is cool.
Yeah, and I was doing this with a client where we were balancing the AM with the down payment, and we were trying to get the numbers to be perfect, right? The return on investment. We're like, where is the best return on investment? So we ended up going with a 35-year AM, but we went a little higher down payment. And it actually balanced out really well for this particular investor who had more capital.
Nice. There's several parameters, and I do this for our U.S. investing, like because we have a sheet that we share with our team, and we tell them go find deals that fit these, and I put all the parameters. I'm like, well, minimum cash flow. You've got minimum ROI, and the ROI really looks at how much money are we putting in. So then the levers to pull on. Okay, we got to finance it higher. We got in our case, we got to get seller financing or a subject to. But in this case, you can go right up to 95. I mean, you're not going to need, or you shouldn't ever need more than 95 on one of these buildings. Otherwise, you might not be looking at the right deal.
Exactly. So anyways, just going back to what we were talking about. So we've run it as CMHC traditional, no MLI.
40-year AM, so that's the difference. So you're 40-year AM on that. You're still getting a great rate. So, you know, comparatively, you got this at 4.25. With the way the bond rate's been dropping lately, I think that there could be in the 3s pretty soon.
On smaller buildings, though, they do charge
a bit more
premiums. Right. So on a 6 unit, although it's less unit count, it's more purchase price, right? And because we're in the 2 million range,
they want to see what, like 5 million?
No, like obviously sweet spot is 5 to 10, 15, 20,
You're
whatever.
Get a better
right?
premium discount.
Yeah. But this could be okay. Like 2 million's pretty good.
Okay, so
2 million plus is pretty good. So it might come in, let's maybe not say, 3.9, 3.8. That's why we went 4.25.
Yeah.
And assuming as well, we're saying this is a forecasted close because this is going to be framed in, completed, let's call it November, December.
And we don't know where things are going to be. Like there are people now thinking the building's on fire in terms of like there's going to be aggressive rate drops. Like there are people speculating that that's going to happen now. They're expecting the U.S. to drop rates. Some people are, rumors of an emergency meeting, and they might drop rates earlier than expected, earlier than September. So what that means for Canada is Canada's not likely to do a lot more rate dropping unless the U.S. starts. So as soon as they start now.
But with the recent news, I do think the U.S. is going to start dropping rates.
So and they were obviously waiting for that. It affects our exchange rate to drop our interest rate before the U.S. does.
Which is crazy right now. I don't know if you've looked at the exchange
it's
rate
like
recently.
$1.38 or something.
It's even worse,
I mean, if it goes up to $1.40, I'm going to send some more money back here because I got money in the States. So great time to send it back.
Anyhow, so just Anyway, so we've ran it that way. Going MLI with this didn't really make sense because we're already maxing out our loan to value, and we have tons of room on the debt service.
Yeah.
Right. Like if we brought the debt service to a 1:1, what's the point? We're still going to be maxing out our loan to value.
Well,
right?
this has got the loan to value in at 85. Like you're not, you could go to 95 potentially, couldn't you, with MLI?
Yeah. But
I think based on what I'm seeing here, those numbers would probably work.
If we did, but we need 100% MLI to get 95.
Oh, you need 100 points. You need 100 points and you don't have that.
I'm pretty sure. I'll double check that.
I thought you could do like a compromise, like 45 year AM, like somewhere in the middle. So 40 is your max with traditional CMHC. You could go to like 45. I think you've told me that before, that you can kind of, if you only get half the points, there's a reduced offering.
There is. Yeah. There is. So anyway, we're running this traditional. We can look at MLI. We'll fine tune it. You know, if you're interested, call us, whatever. But
what's funny is it used to take something, like you used to have to speak to the mortgage broker to get this kind of info, but it's like, obviously you do this so much that it's like, things have really changed. I've noticed that. I've been in this industry a long time. The last two years with MLI Select and like CMHC became the popular thing.
It's the only way to fund right now,
like,
pretty much.
First off, it standardized all the financials, the way everybody shares deals. They're now standardized, which is amazing because you don't have these landlords saying, hey, it's 2% maintenance here. You know, you don't have any more of that, really. I mean, you probably do on the unsophisticated people.
We get a ton of that still.
You still get it? Okay, yeah, you still get it. So anyways, I just see less of it, but it's just like everybody does this now. And where am I going with this? I don't know. I just think it's a lot more standardized. Everybody's speaking the same language. It really makes it a lot easier to talk about these buildings.
I was at the car dealership earlier today, and the guy that met me is an investor, and we started talking. So we're sitting there. We were there for an hour. I was late to our call because of it. Great conversation though, but we were sitting there talking about the MLI program with the dealership guy. And I was like, okay, cool. But how about the truck? Right. Anyways, but it was good. But anyways, just back to this building, because I know we wanted to keep this focused on analysis. So we have the MLI program. We've inserted sort of our own numbers. These are not set in stone. This is not the number the seller's going to take or isn't going to take. We just don't know that yet. But
it's a hypothetical. So the 2.150 is a hypothetical?
Yeah.
There's no indication from the seller what they'll take?
We're close, but I don't want to go out on this podcast and say that's the number, because I don't know that yet.
In some of these expenses, like you got taxes at $5,750, that could very well be accurate for a Sixplex. I don't know in Welland what's normal.
Might be higher, might be lower.
Because that's not assessed
and that's where I wanted to go with this. This is a really unique scenario, right? So that's the good. This is the not necessarily bad, but this is the interesting part that we got to work through, is that we're not going to have any solid numbers. So for insurance, like we have to call our insurance broker and actually say, what is the insurance going to be on a brand new Sixplex with all of this building quality? Then we're going to go to a tax consultant. We're actually going to get a tax consultant to come in and give us a tax rate, right? That has to happen because we just don't know what it's going to be, and it's not going to be assessed till next year.
Yeah, this is
right. So it's all ballparked. With the CMHC numbers, we got our maintenance, our salaries, our interest reserve, or not interest, excuse me, maintenance reserve. So all of those are standardized. So really, it's just the two. It's the insurance and it's the tax dollars. So that's going to be part of our due diligence and part of our conditions on this property. The other nice thing is, if we're to bring an offer today and tie it up conditional upon occupancy permit, right? We now have time to work through CMHC, to work through all of these things. Aiming for let's call it closing in November, December sometime. That seems about right. So it gives us a nice headway here to get all of this ironed out and make the right decision on this building. But I love the idea. And if the rate continues to drop over that period, we're going to benefit that return, right? But right now we're underwriting it as where the rates are today.
So one of the positives I'll throw out there is that it's just with the speculation in the marketplace, it doesn't seem like a increase in rates is likely in the short run. Just based on the narrative that you hear in the media, things can change. Don't get me wrong, and nothing's guaranteed. There are always risks. But if it were me, I'd feel a little more comfortable about that, and knowing that over that time, it's actually more likely that rates come down a bit more than go up. More likely doesn't mean it's going to happen, but it's more likely in my mind anyway.
So all in all, I think it's a great property. I was very excited to go through it, very excited to see what they're doing there. And I don't know, it kind of summarizes the gist of it. Yeah,
well, I mean, let's just go through the goods. In terms of the cash flow, so we're projecting here $2,100 a month, $25,000 a year. and cap rate is 5.6% for those who care to look at that. Obviously, that's a subject to discuss when you're buying buildings these days. And then debt coverage ratio, of course, satisfies. You need the 1.2. Right now, we're projecting here 1.27. Obviously, subject to minor change, so it's good that there's some breathing room there.
Yeah, exactly. Nice. And overall, the other thing is we've already negotiated the ability to lease during the conditional period.
So you can lease it up ahead of time. Yeah, that's cool.
So tie it up, start leasing, hit your numbers, firm up, close the deal.
Yeah, I will say, just back from the student rental days, it's actually almost easier to lease something when it's just studs, because people know there's only one way this can go. You're going to finish it. I'm obviously not renting out wood studs, so I am really getting a brand new. I'm going to be the first to ever live in this. People like that.
People like that a lot.
Yeah. First ever, got that new house smell.
Yep.
Yeah. So definitely, like, I found it was actually easier to rent stuff when it was like literally they could not look at the final product. But that being said, it's good that if you could show them something else that builder did.
Well, yeah. The thing is, that guy's actually built 4 or 5 things
like nearby. Yeah. Just, hey, we'll go over to the other one.
Well, we did that. We were just talking, and he goes, "Hey, how about we go check out this, and then that one, and then this one." We actually ended up seeing 3-4 properties.
That does the trick. Does the trick.
So very easily, you could do lease up. You could even put a ghost ad up. Grab a standard builder grade kitchen, put it on Kijiji, put it on Facebook, put it on whatever, and say, hey, for rent, put the number. Make sure you can target your numbers and you're getting enough action on those calls, right?
Yeah,
that's something we do when
sure,
you have your Collier's reports, you have your market studies, you have your data, but nothing's gonna beat like a true ad where you actually list it and say, here it is.
True, yeah. Like, just let's see what kind of
the quality of tenant
requests,
how many calls are we getting, how many emails are we getting. If you put the ad up at 25 2700 and there's no crickets and there's nobody calling, obviously we got something to work on.
Now those rent figures obviously are a bit higher than some of the ones we talk about. Are these 2-bed units, 3-bed?
So there's 3 1-bedroom units, and the 3 beds are the end units are larger and have more light, more windows, and the middle unit is a bit smaller. And you'll see that reflected in the rent. So I think it's 17, 17, and 15.
Yeah, we've got 2 at 15. We got 1 at 17.
Excuse me. So it's the other way around. The middle unit's the larger, more windows, brighter. Okay. The end units are a bit smaller.
Gotcha. That's right. That's right. Yeah.
And then upstairs is exactly the same thing. So the 2 end units are 3-bedroom units. The middle unit is a 3+ den.
Okay.
And it's quite a bit larger.
So that explains the 2,500. Yeah. Because when I was seeing that, I'm like, that can't be a 2-bed. So 3-bed, that makes sense. And then
3-bed walk up.
3-bed plus den. Now you're really talking.
Yeah. 3 beds up. And then the middle unit has a bedroom den office on the main floor as well.
Yeah. Okay. So,
and there is garages. The upstairs units all have
garages. Now, is that income factored here?
It's not. It's considered built into the lease.
Built into the lease. So you get that if you're buying the big, or you're renting the big unit.
Yeah.
Okay, very cool. Closing thoughts on this one to put a bow on it. Do we already go over it all? I feel like we've said a lot.
Call me before it's gone. I don't know. What's the closing?
Yeah, I mean, the insider, the REI hot seat insiders list, that's our link in the description of the video, or if you're a podcast listener, it's in the show notes. Add yourself to that list, because that's where, like, how is this communicated? Like a deal like this, like how does that go out, or does it go out?
Yeah, so something like this. So our process is, if somebody has a buyer representation agreement with us, they're working with us actively, right? Those are the people that are going to have the direct access, the first access to these properties.
Okay.
Right? We have to legally. We have a contract with these people.
Yeah.
Right. So that's who's getting it first. But if we don't have the right buyer for this product, the next people that this goes to is the insider list.
Okay.
Right?
Gotcha.
It goes from direct buyers, insiders list. Then we'll bring it out to kind of our general database, then it will go out to public if we don't sell it.
Yeah.
Right. So this is kind of our process of.
So it's very common for you guys to never list something, or would never get listed.
Yeah, unless the seller says no, we want to list, which does happen, right? I'm going to be listing a property soon. Nobody's seen it. The seller said we don't want off market, we don't want it blasted, we want it on MLS for exposure purposes, for investment purposes. I said, okay, no problem. So time to time, it has to go to MLS because of request.
Sure, that's normal.
That's the process of how things go. So if you're on the insider list, you're getting these things first.
Yeah, or early anyway.
Early, prior to anybody else in our database. So we ask everybody, join up to the mailing list, even if you're not ready to buy today, but you just want to get your eyes on some of this product, see how it shakes out, see how we're underwriting. All of this gets sent to you guys as well.
And then for people who like, hey, I want to see that, or like those type, they could just reply to the email they get when they sign up.
Send me an email. We'll get in the car. We'll go down.
Yeah.
It's just around the corner.
Just around the corner in Welland. Cool. All right. Well, guys, thanks for making it this far. If you did make it this far, show the channel some love. We love comments, questions. We got a few comments in the last couple of episodes, which is nice. Keep it coming, guys. Like if you want to know stuff, it's funny. We have this like loyal following. It's not huge, full disclosure, but on REI Hot Seat, we'll like, I'll talk to people and they'll be like, yeah, I follow every episode.
Yeah.
Oh yeah, that was that episode 2 days ago. I had somebody tell me, oh, you were sitting in a different seat that other episode. I was. Yeah. Mark pushed me out of my normal seat the other day.
Yeah.
So anyways, but let us know what you want to know about. I know you're there kind of watching, learning, listening. If there's specific topics you want us to cover, by all means, we want to hear it. And with that said, join the list. We'll see you guys again next week.
See you then.